If you're interested in owning a home in Metro Atlanta, call Bob Hale Realty today.
In today's video, I'm breaking down FHA loans because they can be one of the most powerful tools for home buyers. We're going to cover FHA loan limits, FHA requirements, the basics of how FHA financing works, and how to estimate your monthly payment. If you're trying to buy a home and you don't have a huge down payment saved up, or your credit isn't perfect, this video is for you. At Bob Hale Realty, Steve Hale, Robert Hale, and our entire team are dedicated to helping home buyers get educated so they can make confident, smart real estate decisions. I truly believe home ownership can create stability and help families build long-term wealth. Before we get started, let me say this. Don't buy a home just to buy a home. Make sure buying aligns with your long-term financial goals and your family's overall budget. Let's start with a couple of common myths about FHA loans. Myth number one, FHA loans are only for first-time buyers. That's false. Myth number two, FHA loans are only for people with bad credit and no money down. That's also false. Why? I've seen many buyers use FHA loans even when they had solid credit and money saved, because in some cases FHA offered a better interest rate, a lower monthly payment, or allowed them to keep more cash in their pocket. One of the biggest goals of this channel is to help buyers understand all of their financing options so they can choose the loan that works best for them. FHA loans are powerful because they offer more flexible guidelines than many other loan programs. Here's why buyers like them. You may qualify with as little as 3.5% down. Credit score requirements can be more flexible. You may be able to qualify with a higher debt-to-income ratio. Some buyers can qualify for more home than they expected. That flexibility is exactly why FHA loans are so popular. Let's talk about credit score. FHA loans may allow scores as low as 500, but there's a catch. If your score is between 500 and 579, you'll typically need 10% down. If you want to use the more popular 3.5% down option, you'll usually need at least a 580 credit score. And remember, regardless of which loan you choose, lower credit scores often mean higher rates, more fees, or both. FHA down payment examples. Now let's put the down payment into perspective. With 3.5% down on a $1 million home, your down payment would be $35,000. On a $500,000 home, it would be $17,500. On a $400,000 home, it would be $14,000. On a $300,000 home, it would be $10,500. On a $200,000 home, it would be $7,000. And on a $100,000 home, it would be $3,500. When buyers see these numbers, they often realize home ownership may be closer than they thought. FHA loan limits. Next, let's talk about loan limits. The FHA loan limit is the maximum amount FHA will lend on a property. These limits vary by county and property type, and they can change from year to year. So, if you're buying in Georgia, Atlanta, Augusta, or anywhere else, the loan limit in your area may be different than another county. Also, keep in mind, if the home price goes beyond the FHA loan limit, you may still be able to buy it, but you'll likely need to bring more money down. FHA mortgage insurance. Now let's talk about something buyers always ask about: mortgage insurance. If you don't put 20% down, you'll usually pay mortgage insurance on either a conventional or FHA loan. With FHA, there are two types: upfront mortgage insurance premium and monthly mortgage insurance. If you put 3.5% down, FHA mortgage insurance usually stays on the loan for the life of the loan unless you refinance. A common strategy is to buy with FHA now, then refinance into a conventional loan later once you have enough equity. If you put 10% down, FHA mortgage insurance typically drops off after 11 years. Understanding DTI. Let's talk about debt-to-income ratio, also known as DTI. DTI is how lenders compare your monthly debt to your monthly income. There are two types, front-end DTI and back-end DTI. Front-end DTI includes only your housing expenses like principal and interest, property taxes, homeowners insurance, and HOA dues. Back-end DTI includes your housing expense plus other monthly debts like car payments, student loans, credit card minimum payments, personal loans, and alimony. For example, if your total monthly debts are $2,000 and your gross monthly income is $4,000, your back-end DTI is 50%. Lenders use your gross income, not your take-home pay, because everyone's withholdings and deductions are different. Income and employment guidelines. FHA loans typically want to see a stable work history. In most cases, lenders want to see about 2 years of employment in the same line of work. That doesn't mean you can't change jobs. It just means they want to see overall stability. If you're self-employed, you may still qualify, but you'll usually need to provide 2 years of tax returns, and lenders will look closely at your net income. Basic FHA property guidelines. Now let's cover the basic property rules. If you use an FHA loan, the home must usually be your primary residence. In other words, it needs to be the home you live in most of the time. FHA loans can often be used for single-family homes, condos, duplexes, triplexes, and fourplexes. If you buy a condo, the condo project may need to be FHA approved. And yes, FHA can be used for multi-unit properties, which can be a smart strategy. For example, you could live in one side of a duplex and rent out the other side. And that can be a great way to start building a real estate portfolio while still using an owner-occupied loan. Why the right team matters. Another myth is that sellers and agents won't accept FHA offers. That's simply not true. The key is working with a team that understands FHA financing. If the listing agent, buyer's agent, and lender all know the guidelines, FHA transactions can go very smoothly. That's why it's so important to work with an experienced real estate team and a lender who understands FHA loans. At Bob Hale Realty, we help buyers understand their options and connect them with the right professionals so they can move forward with confidence. FHA payment example. Let's walk through a simple example. Say you're buying a home for $800,000 with 3.5% down and an estimated 6% interest rate. That means down payment $28,000, base loan amount $772,000, upfront mortgage insurance financed into the loan. Then you'd add estimated property taxes, homeowners insurance, and monthly mortgage insurance. If your gross monthly income is $15,000, and your debts are manageable, you may still qualify depending on the full numbers. The big point here is this: don't guess. Run the numbers carefully and talk to a licensed mortgage professional. Final takeaway. So what should you take away from this video? If you don't have a 20% down payment saved up and your credit isn't perfect, an FHA loan may be a great path to home ownership. FHA loans can offer low down payment options, flexible credit requirements, more forgiving debt-to-income guidelines, and a real opportunity for buyers who thought buying wasn't possible. Just remember, every buyer's situation is different. The numbers in this video are for educational purposes only, and your actual loan terms will depend on your income, credit, debts, and the property you choose. If you have questions about buying a home or want help understanding your options, reach out to Steve Hale at Bob Hale Realty. Thanks so much for watching, and I'll see you in the next video.